Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
This chart here shows you the correlation between the euro dollar and oil prices. I actually generated this chart from my DealBook 360 platform, and you can see the near mirror images of these two different asset classes. On a weekly chart, we found that the correlation between euro dollar and oil is about 70%, and this basically sort of proves to you what I've been trying to argue, which is that oil, the macro driver of oil, is the predominant driver of not only how currencies are moving these days, but also to some degree how equities are moving. But take a look at this chart. This chart is actually an intraday chart of oil and the euro dollar. And I just pulled this chart on Monday, Monday basically. And the red line is oil, the blue line is the euro dollar. So you can see here that that correlation is not only holding on a longer term level, but even on a pretty much tick-by-tick basis in the euro dollar, it's also holding on an hourly level in this case. And if I brought up some shorter term charts, like a 15-minute chart, you'll see, or a 5-minute chart, you will see a similar type of correlation. So what I hope you can see here too is that the red line to some degree is leading the blue line, which tells us that oil prices is leading the movement in the euro dollar. So if you're new to currency trading and you really don't know what to do or how to get started, one of the things that you could easily begin with is just the theme that's going on in the market right now, which is that oil is really leading the currencies. And the euro dollar, you need to look at it from the perspective of the euro dollar being the anti-dollar, meaning that it's just moving based upon pro or anti-dollar news, and less so on Eurozone data. So what has caused the plunge in oil? Well, I would argue that the plunge in oil is pretty much driven primarily by tactical, not secular repositioning. And what this means is that really it's just speculators getting flushed out and speculators adjusting their positions. We've had quite a few hedge funds blow up. Osprey, which used to be one of the largest commodity hedge funds in the world, basically closed down one of their funds, I think it was last week. And it's because of a lot of the bad bets in commodities. Also, raising cash has become a much bigger issue for not only hedge funds, but also for banks. And because of that, what they've been doing is liquidating maybe some of their more profitable positions, liquidating some of their excessive exposure, and given that the oil has been on a one-way uptrend, it has now also been one of the assets that has been liquidated as well. I argue that's not a secular repositioning because commodities, if it was based on the pure fundamental of supply and demand, would continue to rally for the next 5 or 10 years, because commodities rallies for decades and not years, because it's not as if China's population of 1 billion people is going to just disappear from the face of this earth. Basically, as the country itself, even though they may be facing slower growth, as the country itself continues to modernize and continues to push forward, more and more people are going to need air conditioners. More and more people are going to get cars. More and more people are going to need more energy. And when they need more energy, this is what really moves commodities on a long-term basis. But you and I both know that the rally, the sharpness and the degree of the rally in oil over the past year was not necessarily just driven by supply and demand. It was driven a lot by speculation. And that's why when speculators pull out, the speed of a decline can be just as quick as the ascents that we've seen in the past few years. But I must admit, there are signs of slower growth, which is sort of the fundamental argument that you read in the press, that global growth is slowing, and as a result, what you're also seeing is oil prices reflect that. And then there's been talk of offshore drilling. But all this offshore drilling talk, would be good if it happens, but the effects of offshore drilling that we see would not be, at least for a good number of years. So talk of offshore drilling should not have been significant enough to cause this sharp decline in oil prices in such a short period of time. So, therefore, it goes back to number one, which is that it's a tactical, not secular repositioning that is driving oil prices lower. So, I skipped over to, let me just go back to my theme 1, 2, 3 of what is driving the U.S. dollar higher. We talked about macro themes, we talked about crude. The other thing that is driving the U.S. dollar higher is interest rates. Let me scroll over to my interest rate chart here. The interest rate chart here, you can see that we're having diametrically opposite monetary policies. The Federal Reserve did a very aggressive job of cutting interest rates starting in August of 2007 when interest rates were at 5.25%. The Federal Reserve basically brought interest rates down 325 basis points to 2%. So they have cut interest rates aggressively. They've basically cut interest rates as much as they probably will and probably could in this cycle. But what has everyone else been doing? Well, ECB hasn't been doing anything, in terms of cutting interest rates. The last move that they did in July of 2008 was to raise interest rates by 25 basis points. The Swiss National Bank, the last move they took was to raise interest rates by 25 basis points. And the same thing with the Bank of Japan. Some central banks are beginning to cut interest rates, like the RBA, who cut interest rates by 25 basis points last week. I have the RBNZ's date in red because they're expected to cut interest rates tomorrow. But everyone acknowledges the fact that the Federal Reserve has done all they can with cutting interest rates. And the next move by the Federal Reserve will undoubtedly be a rate hike. And because of that, that is diametrically opposite from what the market actually expects from the central banks in other places around the world. The ECB, with growth slowing, is expected to cut interest rates. Maybe sometime this year, maybe sometime next year. I'm looking at my Bloomberg right now. Let me take a look at how many rate cuts is being priced in. Over the next 12 months, the ECB is expected to cut interest rates between 25 to 50 basis points. And let me pull up the Bank of England here. The Bank of England is expected to cut interest rates between 75 and 100 basis points over the next 12 months. With the RBA, let's pull this up real quick. Okay, with the RBA is expected to cut interest rates by another 100 basis points over the next 12 months. This is all priced into the market, or what the market is expecting.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.